All right, traders, welcome to the weekend video. This is Christian Primer's Tribeca Trade Group, and we've got a lot of things to go over this weekend. A little bit of some lessons from last week that I think we can kind of build on and maybe incorporate a little bit into your trading for this week. Just basically some takeaways from earnings season, and um, and then we'll kind of look at some different charts and just kind of notice where things are and the direction that things are. So let me start with what do I want to start with? So every weekend, the Tribeca Trade Group puts out a weekend newsletter. I like to, when I do these videos on the weekend, I like to paraphrase from there. You have to be a Tribeca Trade member. I mean, this is just kind of the tip of the iceberg in terms of the value and the chart setups and the trade ideas that we put out. So this is basically just the tip of the iceberg. So you really have to be a member, and you can sign up here on our website, which is the first thing I'll talk about. I'll get that out of the way. But you can sign up for the first week just for $7.99, and you can see what it's all about. We have a live trading room that we go over that we have up, and I do midday sessions. I do pre-market sessions to get traders, more full-time traders, ready for the trading day. But we've got a number of services available for the part-time trader. I have a private Twitter feed now where I can send out some of the best looking charts I think that are out there and some trade ideas, and then also my trade alerts, and which is nice. I will say this: I recently switched over. I guess I was in the dark ages. I recently switched over from text messages to Twitter alerts. I could tell you this: the Twitter alerts are a lot better because I could just add charts. I could add exactly what I'm thinking. The text alerts, I really couldn't say too much except for the trade itself, and a lot of it has to do with the setup. So go ahead and check us out, tribecatrategroup.com. Again, sign up, check it out for 1 week, $7.99, and you can see everything that we've got going on, which I think is a lot. Okay, so let's dig into a couple lessons from or some takeaways from this week. So we had a flat week, which again I think is pretty normal overall for the heart of earnings season. You get chop for earnings season. You get a lot of sideways action. There's a lot of digesting of information that goes on. I know for me, by the time I get to the end of the week, the for the 2 weeks that it really where the majority of names report earnings, by the time I get to the end of the week, I'm exhausted just from going over and reading and listening to as many earnings calls as possible, just trying to extract information on what CEOs are thinking right in the current environment versus and going forward. Again, for earnings season, it's always the guidance. It's not so much the last quarter. I think that was something that we talked a lot about in the trading room is that some names really had good quarters, but that's all in the past. It's kind of like the same thing when big investors put out their holdings in the 13F holdings, when they accumulated a position. It doesn't matter. That was in the past. So really what is most important is what the CEOs have to say about their guidance and what they think, if their business is growing or if they think they're at the peak earnings right now. So I said now takeaways a few times, but I think one of the takeaways was that the expectations were really high for some companies going in, and some of these companies that had the really high expectations, they bounced, they went up in the aftermarket, and then they got brought down. And one of the key takeaways that I think, there's that word again, is that investors really took advantage of some of these names going up a post-market, pre-market, and took profits. Previously we've seen investors, wait for the earnings call or the earnings of a company and say, "Yeah, this is really pretty good. I'm going to get involved now." I think a lot of what we saw was profit taking and not investors either adding to positions or starting new ones. And again, sometimes that takes a little time. I think from the first group of names that reported were the financials and the banks, and they didn't have very good price actions there either. But we did start to see a little bit of call buying in some of those names that got beaten up. So what you can how you can kind of think about this is those names that you may still think are quality names wait until if that's what they're doing. I mean, we still have a lot of names to report yet. We've got a big week this week, but maybe not position so heavy into earnings, but just wait for the name to get kind of smoked with the profit takers, and then kind of wait for the dust to settle and go into some of those names. Again, I think that for me is always not always seeing a major sell-off after names report earnings, but at least seeing where investors buy after, especially in option activity, because option activity is really difficult to read going into earnings. I think last week I called it the option activity was approaching the dead zone. It's just really difficult to figure out what people are doing when you see volume go up. You just don't know if people are hedging or if they're doing a little bit of speculation. For the most part, I always think it's a lot of hedging longs, hedging shorts, short positions. Funds need to do that. Earnings is an event, and names really move on earnings. Sometimes a name will move the majority on the earnings date, and then for the rest of the quarter they don't do much. So there's a lot of that volume going up. So again, I like to see where they kind of settle in after earnings, after decent, especially names that had a really good quarter and just got punished for no good reason. And then also where the option activity comes in afterwards. I think that's also pretty useful. Okay, so let me just jump back to the newsletter. Sorry, I have EPI up. I don't know why I have that up, but I wanted to talk a little bit about that chart in a minute. So that's basically some of the things from last week. I talked a little bit how I think the expectations were very high for some names. And then the other thing that you noticed was names that really had a good quarter, and even if they guided higher, their guidance was higher, most of them did not get rewarded for that. There was more names I think that fell post earnings that had good quarters than actually went up. I think Amazon was the outlier. A couple names that the expectations were pretty low. Chipotle, just rocketed higher. So I think those are I don't want to say anomalies, but maybe outlier. There's going to be a couple names like that just surprise where nobody was really expecting much, and it goes, and it can have a couple days of continuation after earnings or outside the Bollinger Bands, which I don't have drawn here, but I'm pretty sure if you put Bollinger Bands on here, you can see that the price is now outside of those. And then really names were hit pretty hard that did not, they were punished. I mean, 3M, got completely blown to bits. Some of the consumer staples names that we saw the week prior really got beaten up as well. So the risk basically is to the downside for earnings. When you have the expectations coming in are too high, you see names really take it on the chin in terms of when they're not at least meeting their earnings expectations, or when they guide lower. They're really getting punished at this point. All right, so that's kind of I'll say the word again, but that's the takeaway from earnings season so far. So again, you don't have to put too many earnings trades on. If that's what we're expecting, especially to the long side. You could play names to the short side. I did that with one or two names, had limited success with that. I didn't catch the names that really got pummeled. But I did play a couple names to the short side. So you can look at it from that aspect. Or you can kind of just sit on your hands and say, hey, I'm really going to be patient and wait for a name that I think gets beaten up too much after earnings, and that name may be attractive to you after they report earnings. So I think I already kind of went over the conclusion here. The one positive that I would take from this, as sometimes I'm very negative when I in these videos, because again, I'm always looking at the risks. Rather than the positives. I'm always thinking what could go wrong in the market, especially with my portfolio. I'm always thinking about what I could lose rather than what I could learn. I do think as you develop as a trader, that's a trait that you take on, is you're not so much looking for the upside and the return, but you're worried about the risk first. Return, of course, is very important, but you want to be cognizant of your risks first. There's a lot to be said, I think, for traders that look at that first rather than just the return side. So on the positive, so that being said, I think I covered enough of the negative. On the positive side, company buyback plans, which have really kind of fueled the market. All of the names that report, for the most part, it's company specific, but most companies turn their buyback plans basically off. They're in quiet periods around earnings, and then after earnings, those buyback machines come back on. So that could possibly give a little bit of an underlying bid to the market once we get through earnings season. All right, so I wanted to talk about the S&P chart, and I've got a couple notes here. I guess we could go right here from my newsletter. But one of the things, and I apologize, I just don't send out on my Twitter handle the S&P chart. There's definitely some things. I don't think that this is really a huge leap of faith, some of the things that I'm putting on here. But the takeaways from looking at the S&P chart is that, since January, since the peak, I have a downward trend line. Price has not been able to get above here. We talked about this in last weekend's video where we halted right at the top of this, or the edge of the downward trend line. And I was saying towards the end of last week, which I'm not going to repeat myself here too much, but I thought maybe it would be what would have been constructive is if we would have hung out and chopped around a little bit at this downward trend line and then went up. That's not what we got, of course. So you have to trade the market in front of you. You can look for that, but that's not what we got. And we pretty much failed, and we failed pretty decently at that downward trend line. And the positive thing is we bounced again for the third time and this is a rising 200-day moving average. So every time we come back and retest it, we're retesting higher levels. So we're getting close to the point. If you notice, that we're making basically higher lows. Lower highs. That would be the correct statement. We've been making lower highs since January. So something's got to give here pretty soon. If you could see, this is kind of a triangle pattern that we're forming here, and something's got to give here. Either we're going to get above this downward trend line, and I'll bring this up here. Either we're going to get above this downward trend line, or we're going to break the 200-day moving average. Now, I just want to cover this because I know some people are so frantic about the 200-day moving average. It's been broken before and we've been fine. So I think you do have to be aware of it and reduce risk. We don't know what's going to happen below the 200-day moving average. Sometimes it can get very ugly. We certainly saw that with 2007, 2008. We broke the 200, came back, retested, so on and so forth. Smart to get out there. But we've done this a few times now. We broke here. We had a nice W recovery and continued higher. Here was a V recovery and then back here. So the reason why I'm just pointing these out is because we're really getting close here to something's going to give. Either we're going to continue to shake out of this. And again, these corrections, they do take time to get out of. I know some people have said like 120 days is your normal correction, that it could last, a deep correction. So we've kind of run our course now. Now it's make or break time. And perhaps once we get through earnings, maybe that will allow us to push higher. But I'm always worried about the downside. One of the things that I'm going to scare you with, so if you don't want to look, you could look away, and I can talk positive in a few more minutes. But look at the unemployment rate. I was talking about this in the trading room on Friday. When I was in graduate school, I went to graduate school part-time while I was working, when I started at Merrill Lynch years back in 2000, basically 2001. First, I started off as a financial advisor. That didn't work for me. It was a really tough time after 2000. And I went to school. I went back to school at Rutgers for my MBA. And I remember in class, I'll just tell a quick story here. But I remember that so what I've got here, by the way, is the white line is the unemployment rate, and the orange line is the SPX. Notice how they kind of, when one is down, the other one is up. So basically what happened here towards the end of 1999, 2000, 2001 is the unemployment rate was extremely, got pretty low, got around 4%. And I remember when I was in class, because we were discussing this, I had a great economics professor, and I remember the economics were coming out super bullish, and the market wasn't going up anymore. The market was in fact starting to go down. It was not reacting anymore. The unemployment rate went from 8% back in what is this 1992, and just fell throughout the years to all the way 2000, fell to the lowest around 2000. And I remember the last couple times that the unemployment rate and the economy was growing. I think it grew, continued to grow in 2001, and the market was actually selling off on it. There was no more good news. The good news was completely priced in, and the market started to fall. So it reminds me a little bit of what we saw last week with earnings, where companies are reporting great earnings, even their expectations are pretty good, and the market sold off, or individual names sold off. So now I don't know. I'm not trying to scare anybody, but I think you have to be cognizant that's not a good signal when companies report good earnings and they go down. And again, I'm talking about mostly guidance, which I think we saw a lot of companies report pretty good guidance. So we could be at the end of the cycle here. And again, it feels a little bit familiar to me for me when I was sitting in economics class, scratching my head saying, what's going on? The economy is growing and the stock market is not going up anymore. Keep in mind, stock prices are a leading indicator. So when they start to fall on good news, usually we're at the top of a cycle. So I think it's still a little bit too early to tell. What I would watch, going back to the technicals, is watch for that break of the 200-day moving average. And the main point of me going over that story for a couple minutes is honor your stops. If things start to get a little bit dicey here and we go a little bit lower, I think at this point, first of all, we don't have that far to get to break to the 200-day moving average. So at this point, if you have positions on, you're not going to suffer that much here, as long as you honor honor your stops. So I think that is very important. If you don't honor those stops, and we have a bigger market correction, it's going to hurt pretty bad. But if you're pretty calm about it and keep a higher level of cash, you could kind of get out of this pretty unscathed or small losses. And that's really what trading is all about, is getting out with small losses and not having those big losses, right? Big winners and small losses. So I know that sounds so easy, but it's really up to the trader to kind of commit to that trading plan. So again, and I put, these are, I did not want to put a doomsday chart up there, but there's always risks in the market, and there's always a chart that could look really like as an ominous sign. I could come up with people do that all the time. They compare the US to the Japanese market. They compare, just a whole bunch of things. But set your stops, and if, there's no reason to kind of speculate on that kind of thing, in my opinion. If your stops get hit, take your positions off. And right now, it is what it is. And, I've been saying this for the last couple of weeks, and I sound like a broken record, but, the trend is sideways. This is not a place for me, to add a lot of risk. It's to trade less and to trade smaller. And that's what I've been doing the last few weeks. And it's been frustrating. Trading really small size and just kind of waiting for this to kind of come out. But it's, the other the takeaway word, but on these green days, it's not been the place to add risk. Adding risk where things are short-term oversold has been a better place to add risk. All right, so that's a lot about strategy. I just went through about 20 minutes, talking about strategy for next week. But it is what it is. I think it's important to go over some of these things. All right, so fund flows for last week. Just a couple of takeaways. I'm not going to spend a ton of time here, but interesting utilities. There's so much talk about, and really, I think you kind of have to turn off the TV sometimes because all they've been talking for a couple of days, all they were talking about was rising yields, and they really backed off. They're moving up pretty slow. And utilities, which is very yield sensitive, actually saw the biggest inflow last week. Healthcare, staples, these are all, I would say, a little bit yield sensitive, defensive areas of the market. These are the sectors that saw inflows last week. Interesting, I think XLU, which I have up right here. So here's the inflows, which you can see on Bloomberg, up to the 200-day moving average. So it's been grinding higher since this February low. I'm actually pretty shocked at this, but this may be a place to short. I don't know. We'll see if it fails here at the 200-day moving average. It hasn't been such a big mover that I think you can make a ton of money. But if it fails here at the 200, probably a pretty good signal. But again, it's been moving so slowly. All right, so that's the other takeaway from here. Again, I keep saying that word. I apologize. The Qs had the largest outflow of any ETF last week. So it was kind of similar to what we saw when the banks reported earnings. They saw some outflows in the financials. XLF saw some big outflows right around the time that all the banks reported earnings. The Qs and technology last week saw outflows. $1.5 billion taken out of the Qs. Most of that was done prior to when Amazon, Facebook, and some of the bigger tech names. Although, sorry, Amazon is not tech; it's consumer discretionary, but still in the Qs nevertheless. So $1.5 billion taken out there. Also, industrials, which saw big inflows the week prior, they saw $700 million of inflows 2 weeks ago. This week they see 900, or almost $1 billion of outflows, and that's basically how the U.S. sector flows have been this year. Very whippy, I would say. Whipsaw. 1 week big inflows, next week big outflows. There really hasn't been a lot of good trends to follow. I was just on Bloomberg last week talking about just a few areas that I think have been pretty consistent. It hasn't really been like 2016, 2017, where there's been money just every week being added into some groups. It's been pretty inconsistent. All right, so that is U.S. sectors. In international, a little bit of an uptick in inflows. They saw $2.1 billion previous week. It's been running a little bit less than $1 billion, I'd say, for the last overall for international. It's been running a little bit less than $1 billion for like the last month and a half. So they did see $2.1 billion. Most of that went into developed market ETFs. One in particular, IEFA, saw $1.3 billion. That is a combination of Japan and Europe. European specific ETFs, 9 weeks in a row of outflows. Although they did not see that much last week, only 129 million. So I think that's one of the lowest weeks. Even though it's been 9 weeks of outflows, this was the lowest week of outflows. Fixed income space, again, whippy stuff. 2 weeks ago, or I guess was it 3 weeks? 2 weeks ago, HYG, JNK, the high yield bond ETF saw big inflows. 2 weeks ago, they saw big outflows. Then last week they saw more inflows. HYG saw 800. It should be right here. $858 million of inflows. So it's been, every week is a different story that you could basically write for journalists. I know they love to say when they have outflows, they don't mention it when there's inflows. But last week they had inflows. I guess it's more of, it turns more pages when they mention the outflows. Oh my gosh. The short-term treasury ETFs added more assets. There was a report out that got a lot of coverage about short-term bond ETFs saw a lot of inflows over the last month. We've been all over that. If you're a consistent viewer of this video, or you're a member, you got that information 3 weeks ago about the Treasury bond inflows. They report things, so it's so old. It really is. I heard that at least 3 or 4 times last week, and that's great. If you wanted to know what happened 3 weeks ago, then have a ball. But we covered that, and that's all on my Twitter feed. I talked about those dramatic inflows into short-term bond ETFs 3 weeks ago, and money out of the U.S. market, equity markets. So, nevertheless, they're still adding assets. SHV, SHY, BIL. They're almost all the same, but they're still seeing inflows. Not huge, but they're still seeing. We're talking about $250 million, where overall equity ETFs saw $2.8 billion. So they are still seeing the inflows, but certainly they're not. It's not like it's one for one. And again, it's still equity ETFs saw inflows, $2.8 billion. So I just want to make sure you see that. Also, Treasury, longer dated Treasuries saw inflows as well. And then gold, now 5 out of 6 weeks, even though gold has not been doing anything, very range bound. 5 out of the last 6 weeks seeing some inflows. Lastly, VXX, which saw a big inflow 2 weeks ago, saw a big outflow last week, $325 million. All right, so that's it for kind of the summary and going over ETF inflows and outflows. So what I want to do is kind of focus on these were a couple notes from what we talked about in the trading room on Friday. Is that I think focusing on some different areas of the market, where there's a little bit of momentum, and I see two sectors, outside of tech, which I think has been a lot of people's focus for a while. But really, what's been going on in retail has been pretty interesting. A lot of retail names are starting to break above. So I highlighted a bunch of names. So first of all, XRT. There's a couple of ETFs to look at. XRT is the equally weighted ETF. So what does that mean? Every name gets the same amount of exposure in the XRT ETF, and you could see that it's actually trying to come out of range here. It's above value. You've had these value areas that have been declining, but look at the new May value area. It's actually the same as April's. Maybe a little bit, I guess, like an inside value area. So it's got a chance. This was the highs back in January, so that'll be interesting if retail manages to lead the market, which it did last week. It was one of your best performers. And then also the RTH ETF, which Amazon is a big weight in this ETF. Amazon is about 20% of the weight. RTH is market cap weighted, meaning the largest companies like Amazon will get the bigger weight. XRT, if you're looking for more of a diverse retail ETF, then that's the one for you. But they do look similar. It does look like RTH is a little bit is outperforming XRT, again because of that big weight in Amazon. And then if you kind of go through some different names in here, Ross Stores, this was a name, if you're a member of the Tribeca Trade Group, I put this trade on a couple weeks ago in Ross Stores. Why did I do that? Because they had good earnings. So here's a good example, right? Really good earnings for Ross Stores, and it falls apart. But it held support. It chopped around. It was coiled for a number of weeks, where all the moving averages are kind of wrapped around one another. And you got to be patient, because I put this trade on, I think 2 weeks ago, and it's done nothing. And then all of a sudden, towards the end of the week, it moved. So the way that I kind of look at these groups, for me, I honestly don't want to go crazy long in retail, but I want to have a couple positions on if they look pretty constructive. Look at TJX, 52-week high. A couple of other names, Target, which was mentioned by my colleague Pat Harris last on Friday, had a real nice day. And again, a lot of these have the same pattern as that ETF. So you can kind of pick. What I like to do is have position in the ETF, and then maybe a smaller position in a couple individual names. A name with a big short interest is Restoration Hardware. Look at the move this thing made on Friday, up 6%. Watch for this thing. Shorts go scrambling when this, when there's a big rally in Restoration Hardware. So just above that downward trend line as well. So I would keep an eye on this name. I think it's worthwhile to maybe have a speculative position in this one. Maybe versus this new top of value. A couple other names in this group that I pointed out. Walmart. I believe Walmart reports earnings next week. So again, I like to point out names that have not done anything yet, that are on my watch list. And this kind of looks coiled as well. It's been fighting with that 200-day moving average. I think actually it's above the 200-day moving average. This chart is non-dividend adjusted. So if you factor in dividends, it's probably above. But this reports 517. So I would keep an eye on this name. Sometimes these names will kind of lull you to sleep and then we'll get going. So I do not have a position on it in Walmart, but it's something that I'm looking at for next week. All right, so there's a number of other names that I could talk about. I'm not going to do that. I will only do that for Tribeca Trade Group members. But the other sector that I'm looking at is healthcare. Healthcare's done nothing and is now back starting to move a little bit here. And what I talked about in detail in the trading room on Friday was the difference between large cap biotech, which looks pretty ugly, versus large cap healthcare. These bigger names, which were the darlings of the market in years past, they all look ridiculous. Celgene, it is kind of putting in a base here a little bit, but it's well below the 200-day moving average. Regeneron, it was another darling. Not looking great. Did put in a hammer bar on Friday, but anything below the 200-day moving average is kind of a hands-off for me, unless I really want to speculate with a small position. Biogen did rally a bit from earnings, but again, just looking at the overall pattern, these are way in downtrends, so probably worthy of some bounces, but just to kind of show you the trend is bad for all these, for all the big biotechs. Amgen is another one that maybe probably the best, even though it looks like the best out of those names I just mentioned, but sideways. So now that I've showed you these charts, take a look at Abbott, which is one of my favorites. Just trying to flirt with this value area and get above. So I like that it's consolidating here. AZN, all the A's in the pharmaceutical. It's pretty funny. So you don't have to, easy to remember. I think AstraZeneca is probably my favorite, which saw a little bit of call activity last week. It bounced on that bottom of value and now above the short-term moving averages. So this is probably my favorite out of the group. What's the other one? AbbVie, which has really gotten punished, but held the 200-day moving average pretty nicely. I would watch that bottom of value to see if it could continue to go here. But nice hold of the 200. Getting away from all the A's in the healthcare space. I think Pfizer looks interesting here. Again, much healthier looking. All the prices above the 200-day moving average. And, you're not exactly getting this at the low point here, but it is starting to get back above here, the value area. So that's a couple names that I'm looking at. There's a number of other names, but I think I'll stop the video here. I'll just talk a little bit about option activity. Option activity, really difficult with earnings season, as I said in the beginning of the video. A couple names to watch. By the way, let's be honest here with option activity. For me, as I always say, it's ideas, right? Sometimes there's one-trick ponies that are on that all they look at is option activity. In my opinion, that's really short-sighted. And if you're only talking about, if you're only cherry picking the winners, if you've talked about a whole bunch of names and you're only cherry picking the winners, you're really doing everyone a disservice. And I can talk about, it is what it is. There's a bunch of names that saw all kinds of aggressive option activity and they haven't worked. So you really have to rely on something else than option activity. It is not the end all and be all. I read the tape, I look at option activity, but do not fool yourself. This is not the end all and be all. And just because the other thing that can lead to a lot of losses is people will put so much faith because they saw calls being bought. Do not do that. If that worked all the time, then hedge funds would be just killing it. But they're not. They ain't. So you need something else. For example, Masco saw a whole bunch, and I'm not gonna show every loser that's seen aggressive option activity. Again, aggressive option activity. That's mainly what I look for. But you have to have another rule. You have to have something else. So this is one that saw repeat call activity and just fell flat on its face. Even before, it gave you an out, breaking below the 200-day moving average. But very untruthful do I see a lot of people on Twitter who will just retweet or just after the fact stuff. What some of them like to do, and again, sorry I'm venting on this video, but what some of them like to do is talk about tweet about every time there's aggressive option activity in something. Sometimes it's 50 names. The more they do it, the better. Because then the 5 or 6 that move, they could retweet the hell out of it. Oh, I called it. Do you have a position in it? No. But you're right. You called the 5 names out of 50. That's aggressive option activity. All right, so so that's I'm going a little bit overboard here, but it is what it is. People are really dishonest. So Yandex, I will tell you, I have a position in the Yandex. A name, I think something is interesting here. It's worthy of taking a shot at. They have bought calls aggressively after earnings, which is what I like to see. So I am kind of sitting in a position that's down a little bit. I do leave myself plenty of room. I have not added to this position yet because I don't want to add to it just right off the bat. I've got a little bit more time in this one. It's an August position, but a lot of Yandex calls, repeat Yandex calls went up last week. PayPal saw an interesting trade last week after earnings. Here was the PayPal trade. This just hit on Friday, October 75 calls. I took a starter position in this one on Friday because I just did not want to add a ton of risk going into the weekend. But pretty decent sized trade there, $3.2 million. I thought, like I said, there was a little bit of AstraZeneca calls. So that's it. I'm not going to go through all these names because there was a ton of them that are earnings related. Earnings are a couple days away. One international ETF that I thought was interesting was Turkey. Short dated calls as well. The other thing is a lot of short-term option activity. So, so this is the other thing that I find funny is that if somebody's buying May calls, how long are you gonna own May calls for? And that's the majority of the transactions that we're seeing. Those are all short-term. So how long are you gonna own those, or how much risk are you gonna put behind May calls? Probably not too much. I look for the longer dated positions where you could give it some time and you could be patient and let it kind of do its thing. But if you're looking for just a trade, somebody bought Turkey options, TUR, last week. Again, horrible looking chart, maybe a double bottom forming in here, but just for a trade, short-term trade. All right, so that's the rest of the option activity I go in detail in our live trading sessions, as well as I do send videos out during the week. So I'm not going to go over every single trade that happened, but there's a couple other ones that I thought were interesting, but you have to be a member to see that. All right, guys. So I'm coming upon the 40-minute mark, which is longer than I wanted to go. So that's it for the weekend video. Check out TribecaTradeGroup.com. Sign up, get your first week for $7.99. Thanks very much. Enjoy the rest of your weekend.